moving averages. That's something I added to our to William O'Neill's institutional products maybe 20 years ago. The two moving averages, for all sorts of reasons, but ended up kind of stumbling into how powerful it was to hold you in a stock. Let's pull up ELF, because that's going to be one that we're going to talk about with this. And let's look at it on a weekly basis. You can use this on daily, weekly, and monthlies, but for this segment, we're going to go ahead and focus it on the weekly. And you can, for this segment, we can do the best fit just so we can get the whole chart in there. I typically don't use that because it squishes the scale. But what you're focusing in on is that the green line, which is your relative strength line. And like Justin was saying, it's just a ratio versus the S&P. So if you're not familiar with it, if the S&P goes up 1% and your stock goes up 1%, so it's in line with the market, that line is going to be flat for that period. But if your stock is up 2% and the market's only up 1%, then it's going to show a small increase. And of course, the reverse if it's down more. So you're looking at over time, what is that RS line doing? And using these moving averages will tell you, is it in an uptrend or not? Or is it just chopping around? And these particular values seem to work the best from the research that I've done. And like I said, I've been using variations on this for 20 years since I originally developed these moving average lines on the relative strength. And recently, over the last few years, I was looking for what can I do to solve a problem I have. Do you guys have any problems?
I got a lot of problems, Mike.
That's a whole nother podcast.
Yeah. But holding, I think that the key thing is you have a great winning stock, right?
Oh, you were talking about problems with stocks. Never mind. Okay,
Yeah,
I thought, yeah, okay.
So my problem
I'm with you.
was holding, and I think it's probably a common thing. You either sell too soon or you sell too late, and so let's say you do all this work, you do all this research, you read these stories, you wait for the breakout, you buy it, yay, everything's great, and it's moving up, and for whatever reason, you get dislodged from that position because you didn't have a rule to hold a core position. And so I wanted to develop something for myself, and I'm just sharing it with the world in hopes it'll help others. And so what I do is I say, okay, is once you bought the stock, and to buy it, you want it to be in a good position. And by good position, I mean the relative strength line itself is above its moving averages, where it was at that cup breakout that he's pointing to. So let's say you're buying it out of there. Once you have a gain on it, to hold your core position, you're waiting for it to break these moving averages. And I've got 3 specific rules to use to kind of sell and reduce your core.
And Mike, just very quickly, when you say core position, what does that mean, or how big a position?
Okay, so everyone is going to be different. Some people like to be spread out. Some people like to be concentrated. So for sake of for this session today, we're going to just say your maximum position size is 25% in any one stock. Now, for most people, that's crazy and too concentrated, but we're just going to use that for this segment. For other people, maybe you do that all the time, but we're going to say your maximum position size is 25%, but your core is less than that. Your core is what you're going to try to hold for the big move. Let's say that's a 15% position. Okay. So you would have 10%, a 10% position of that. You're going to be selling into strength, or selling because the market's coming in, or earnings are coming up, or for any other reason. But once you have a decent gain, you want to hold your core position for today. We're going to say it's 15%. Does that make sense?
Yep. Yeah.
Yep. Thank you.
And it's large enough, that core position is large enough that it moves the needle on your portfolio if you get a winner. But again, it's not so large that you can't manage your risk to your portfolio if you have a normal correction. I mean, like that correction in ELF, the most recent cup, I mean, that was a 37% correction. Yeah. Would you want to have a 25% position and take a 37% hit in the stock? probably not. So yeah, you're going to
No,
want to trade around.
I couldn't withstand that. Now, towards the end of Bill's career, he wasn't doing a lot of that either. Now, early in his career, when he was younger, when he had Pick and Save and Price Company and some other stocks, he would sit through big bases.
Mhm.
So it just really depends on how you're wired. And I'm not wired to want to sit through a big base like that, but I want to try to capture as much of that move up as I can. So what I developed was basically a holding rule of you're going to hold that full core position. So in this case, 15% until you get that green line breaking one of those lines, your faster line right there. So when it breaks it, then you need to sell some. For today, we're just going to say we're going to sell it in thirds. But typically, you'd be looking at it and saying, you would look at how good the stock is, what your cost basis is, whole bunch of things, and maybe you only sell
where the market is in relation to its regression channel lines.
Yeah, all sorts of stuff, market school rules. And then you would say, okay, maybe I'm going to sell 10%, but you want to do some selling when it breaks the first time. I call that the quick, because in Bill's book, my favorite line was there's the quick and the dead. And so I thought, okay, I'm going to use this because it always helps me to have kind of catchy things to remember, indicators by, or little stories that Bill would tell. So I said, okay, when it breaks it the first time, I'm going to be quick and get out of some. So you sell maybe 10 to a third of your core position. So you've gone from a 15% position now down to a 10. Now, if it starts going below that, so that's your first break where your relative strength line is moving through crossing your moving average. Now, if it goes below that a little bit more, it can just drip, 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 drip and get worse and worse. And so I call that the quicksand. That you can get into this thing where it's kind of like Bill's turkey story, where if you haven't read Bill's book, get the turkey, get it out and reread the turkey story, and this will make sense to you. But anyways, you're not wanting a big gain to turn into a little gain and lose all your turkeys. So if it goes down a little bit more, which it did there, then you're going to sell. You're going to sell some more, but you're going to hold that last 5% until it breaks that blue line, which is your longer term moving average. Now, there's nothing that says that you can't buy it back. In fact, you should, but you want to wait for that green line to be back above both moving averages before you add to your stock. So let's just kind of recap this, because I know there was a lot going on. You had your cup. The moving averages were properly underneath that RS line, or the RS line was above them. You buy it, you've got a decent gain at some point. It comes down and it finally touches your moving average. So you're selling some, it goes a little bit lower. You're selling a little bit more with the quicksand, but you're waiting to sell that last 5% until it really breaks that blue line. Now it's moved up and it's giving you some chances to buy. So you might have ramped your position all the way back up to a 25% position during that. Then again, we get the quicksand, the quick and the quicksand over there. You're reducing, and then you get what I like, because I'm a deadhead, I call it the Grateful Dead break. And it's a little goofy, but it's something that I can remember. And so not there, but a little bit over to the left. When it breaks it the first time, that's when you exit the entire position. And so that allows you, that's a black and white rule that would have allowed you to buy it at that cup and hold it all the way through and get the heart of the watermelon, as Bill used to say. Now, then when it forms this next base, you buy it, you can buy it back, and then you're using those same exact rules to exit the position. And you saw how it was breaking through today.